We may be far away from Washington here in Davos, Switzerland, but we are still watching the Federal Reserve, of course, and the U.S. economy. So let's talk about the outlook for rates and the global economy as well as the U.S. economy with Ann Walsh. She's CIO at Guggenheim Partners Investment Management, which has about $225 billion in assets under management. Ann, welcome.
Thank you for having me.
Thanks for being with us here. So we've been talking to a lot of folks about the idea of the soft landing. And, I know that you were somewhat skeptical at certain points that we were going to be able to achieve it. Where are you now on that question?
Well, I remain in the skeptical camp. I think that we've seen the yield curve being inverted for 300 plus days is a precursor to recession historically. And our view is that we are going to see a mild recession. We're not going to see the big pandemic or global financial crisis kind of recession, just a good old-fashioned slowdown in business. The soft landing idea is based on a belief that we'll be able to manage to have a below-trend growth, so below 2% GDP, but not yet fall into recession. We're just a little bit more concerned that the economy will slow down more than that soft landing view.
So Ann, if you are in that mild recession outlook, are you in the camp of 6 rate cuts this year?
Yes, we are. And we're in the camp that they begin in March, which is more aggressive now that it seems like a lot of the market peers are believing. We think the inflation story is definitely a good one at this point in time. Inflation is coming down. The trajectory is in the right direction. I know CPI print was elevated, but that was driven a lot by owner equivalent rent. And that component is stubbornly holding up relative to the PPI, which definitely showed us the direction and trend for inflation is down. And so we believe that that's still going to hold for the rest of this year.
Do you think that there will be not just more signs of inflation coming down by the time that March meeting rolls around, but also more signs of cracks in the economy becoming apparent? And if so, what would those be?
So I think of the economy as almost two economies now. It's very bifurcated. There's the big companies, the big market participants. They all seem to be doing pretty well. They're coming into this slowdown cycle with a tailwind. And the tailwind is they've been able to pass along their higher costs, their margins have been protected, and they have access to capital. However, the small and mid-sized businesses in the U.S., which make up about 50% of the GDP, I think that's a different story. They're going to be having to refinance as a refinancing wall is coming with commercial and industrial loans, particularly in small and mid-sized banks. And they're going to be refinancing at much higher rates, particularly relative to what the big participants can borrow at. They're still borrowing at prime, 8.5% to 10% or more for those small and mid-sized businesses, if they can access the capital at all. Otherwise, particularly for small businesses, they may be forced into credit card borrowing.
So potentially 6 rate cuts beginning in March, slowing economy. A lot of the investors that we talk to for Yahoo Finance, they have a whole portfolio of tech stocks that they still own from the back half of 2023. To those investors, how do they build a portfolio to withstand the environment you're talking about?
Well, it's sort of interesting as we sit here in Davos. It seems like the theme this year is technology, and particularly artificial intelligence, as it has been in the stock market, certainly in 2023. And I think that theme will continue. I'm a bit more concerned that there will be some softness in the stock market overall. And technology is one of those kinds of mispriced elements of the market. The markets tend to overprice in the short run and underprice in the long run. And I tend to think of it in the long run as being a really good story to tell. But that doesn't mean there won't be some volatility in between. And so I would anticipate that investors who want to hold on for the long term, absolutely, the story is a good one. But in the short run, you're going to have to probably see some downtrend in pricing.
Do you add fixed income, and what allocation in your portfolio should be fixed income?
Absolutely. Fixed income has historically done very well when the Fed has paused and begins their easing cycle, which is exactly where we find ourselves. We think that rates are going to continue to fall. In addition to the short end, we think the long end will come down, and that the 10-year Treasury will come down to about 3.5%. And so if we're going in that direction, fixed income, particularly investment-grade fixed income, is going to perform very well in that environment.
How does all of what you're saying seg with what you're hearing here in Davos, right? Because, the vibe on the global economy, I know that the World Economic Forum's own survey of chief economists found, 56% expect a global economic slowdown. So what are you hearing here that sort of stands out to you on that front?
Well, I hear cautious optimism about so many aspects of the economy, both in the U.S. and globally. And I think that sort of falls into my large companies are going to do well theme. And then there's going to be some performers that aren't, players that aren't going to perform quite so well in the economy. That is what I'm hearing here as well. The other element is globally there's a slowdown. We saw Germany's numbers this morning, and that's the second quarter in a row that they've seen negative GDP. We also see China slow at this point in time. So globally, the story is definitely below trend growth, likely close to or seeing recessionary-like backdrop.
There seems to be a lot of a good amount of concern on the ground here at Davos about the election, the potential election, not only the outcome, but in the months leading up to it. Is rising geopolitical risk, is that the trigger point for the market sell-off you just suggested?
Well, what we're seeing right now in markets is generally increased tail risk. So overall, we have more idiosyncratic risk. We have more specific risk to individual entities. We have more geopolitical risk. All of these elements could certainly lead to, dare I say, some sort of a gray swan event, but that's not our current base case. Our current base case is that these geopolitical events will continue to unfold, but not create some sort of a huge sell-off themselves. Also, markets do a very bad job of predicting and pricing in geopolitical risk until that's a rear view mirror kind of environment. So as a result, we're looking for it. We're always being thoughtful, but because of that backdrop, tail risk is higher.
I like that. Gray swan. And Walsh, great to catch up with you. Thanks for being with us.
Thank you very much.